Determining accounting income and the deductibility of expenditure for corporate tax purposes. The process of determining accounting income involves deducting a business's total expenditure from the revenue generated during a specific tax period. This calculation provides the net income that reflects the financial performance of a business. However, when it comes to corporate tax purposes, not all expenditures recognized under general accounting standards are considered deductible. Therefore, businesses must understand the distinction between allowable and non-allowable expenditures to accurately calculate their taxable income for tax purposes. 1. Calculating accounting income. Accounting income is derived from a business's financial records, primarily by subtracting the total expenditure from the revenue generated within the same tax period. Revenue refers to all the income earned by the business, including sales of goods and services, interest, and other financial inflows. On the other hand, expenditure refers to all the costs incurred by the business in order to generate its revenue. This approach is guided by general accounting principles and standards, which align with the idea that expenses incurred to operate a business should be subtracted from the income it generates, leaving the net profit or loss for the given period. However, for the purposes of determining taxable income for corporate tax, some of these expenditures may not be deductible under the tax laws. As a result, adjustments need to be made to the accounting income to account for these non-deductible expenses. 2. Non-deductible expenditure, adjusting accounting income for taxable income. When calculating taxable income for corporate tax purposes, any expenditure that is non-deductible under the corporate tax legislation must be added back to the accounting income. This ensures that such expenditures do not reduce the taxable income and thereby affect the corporate tax liability. The distinction between deductible and non-deductible expenditures is important because it ensures that the tax calculation is based on what is legally permissible under the corporate tax regime. While general accounting practices allow for various types of expenditures, the corporate tax system specifically defines which costs can be deducted. Therefore, businesses must differentiate between allowable expenses and those that will need to be adjusted back into the taxable calculation. 3. General rules for deductibility of expenditure. The general rule for deductibility of expenditure under corporate tax is that the expenditure must meet two key criteria. 1. Wholly and exclusively incurred for the business. Expenditures can only be deducted if they are wholly and exclusively incurred for the purposes of the taxable person's business. This means that the expense must directly relate to the operation of the business, and it must not be personal or unrelated to business activities. For example, an expense incurred for the business's day-to-day operations, such as the cost of raw materials or employee salaries, would generally be deductible. However, personal expenses or any costs that do not have a direct connection to the business's operations would not qualify for a tax deduction. 2. Non-capital in nature. The expenditure must not be of a capital nature in order to be deductible. Capital expenditure refers to expenses that are incurred for the acquisition of assets or investments that provide long-term benefits to the business. Examples of capital expenditures include purchasing land, buildings, machinery, or other assets that contribute to the business's productive capacity over a long period. These types of expenses are typically not deductible in the same way as operating expenses. Instead, they may be subject to depreciation or amortization over time. In contrast, revenue expenditure, such as routine maintenance costs or operating expenses, can generally be deducted in full in the period in which they are incurred. 4. Specific rules for deducting entertainment and interest expenditure. In addition to the general rules for deductibility, there are specific guidelines for two categories of expenditure: entertainment and interest expenditure. These categories often require more careful consideration, as tax authorities may impose stricter rules to prevent abuse or misuse of these deductions. A. Entertainment expenditure. Entertainment expenditure refers to expenses related to hosting clients, customers, or other business-related parties, such as meals, entertainment events, or hospitality services. In many jurisdictions, including the UAE, entertainment expenses may be partially or fully non-deductible for tax purposes. This is due to concerns about the overuse of business funds for personal enjoyment under the guise of business activities. For example, if a business spends money on dining or entertainment for employees or clients, the tax authority may limit the amount that can be deducted. The specific rules governing the deductibility of entertainment expenses are typically outlined in the tax legislation and may vary depending on the purpose of the expenditure, the nature of the business, or the relationship between the business and the individual entertained. B. Interest expenditure. Interest expenditure is the cost of borrowing money and includes the interest paid on loans, credit lines, or bonds used to finance the business's operations. In many tax systems, interest expenses are generally deductible as long as they are incurred for business purposes. However, there are often limitations and restrictions on the amount of interest that can be deducted, especially when it comes to thin capitalization rules or where the business is engaged in excessive borrowing that could lead to an aggressive tax strategy. For instance, businesses that are highly leveraged, i.e., have a high ratio of debt to equity, may be subject to additional rules that limit the interest deductibility to prevent tax avoidance practices. In such cases, businesses may be required to prove that the interest expenses are within reasonable limits and are necessary for their business operations. 5. The process of adjusting accounting income to calculate taxable income. The process of calculating taxable income begins with determining the accounting income from the business's financial records. From this accounting income, any non-deductible expenditures must be added back to ensure that the business does not benefit from tax deductions on ineligible costs. The key steps in this process are: 1. Start with accounting income. This is the net income figure derived from the business's financial accounts, calculated by subtracting the business's expenditures from its total revenue for the period. 2. Add back non-deductible expenditures. Identify and add back any non-deductible expenses to the accounting income. These could include personal expenses, capital expenditures, and certain other disallowed costs such as entertainment and excessive interest expenditure. 3. Adjust for capital expenditures. Capital expenditures, rather than being immediately deductible, may need to be capitalized and depreciated or amortized over time, depending on the nature of the asset. 4. Apply specific rules for interest and entertainment. For specific categories like interest and entertainment expenditures, apply the tax rules that limit or disallow deductions, and ensure that only qualifying costs are deducted. 5. Arrive at taxable income. After all necessary adjustments, the result is the taxable income, which is the figure that will be used to determine the amount of corporate tax owed by the business.